Hey traders, Nick Shaheen here looking at Starbucks. Well, this is not Starbucks. I was discussing Oracle with a friend and I set an alert. Okay, so Starbucks. I have a bone to pick with the price action, so I'll start with that. But before I go into details, I want to assure you that I'm not a hater of the stock. So if you've got issues with me saying, hey, maybe this isn't the best time to get long Starbucks from an investment perspective, not trading, investment, then just wait for a second. Let's see here. Last year, I remember on March 17th, I wrote an article. It's published out there. You can Google it. Saying common sense will return, basically catch the falling knife. That was hours before it actually set the bottom last March on the pandemic. So right there is proof that I'm not a hater of the company, and it made common sense to catch the falling knife because the selling was overdone. And I said, common sense will come back, will return, I think the words were. And guess what? They did. But then they threw them out the window again and went the other way. And that's the beef today. So if somebody's saying, if my brother comes to me and says, or my mother for that matter, and says, hey, what do you think of Starbucks? Here's my answer. I wouldn't say short it. I wouldn't say, oh gosh, this is a terrible company. None of that. I would simply say, this is not an obvious point of entry. This statement could not be any more true because I can't short it. I have nothing to shoot against. Like if it was here, I'd say I'd short against this failure, but there's nothing. It's in all-time highs. Therein lies some of the problem. I don't want to short the bulls who are in control of this price action. Technically, they are definitely in control. That's why they buy every dip. That's what's happening in the whole market type of a deal. I don't want to short it because I don't like shorting companies. I sometimes short here and there, but via very gentle debit put spread or credit call spread, it doesn't matter. It's not like I go out and sell the company with harm intention. So in this case, I would say this is not an obvious point of entry. I would also say I'm very confident that we will have a chance to get into it at a much lower price this year. Where? Definitely at 104, more likely at 100. People love round numbers. Very likely around 92. It's not a long shot. I see it happening. I'm not saying short it because I'm not all about that. This is a place from which they broke out, technically. It makes sense for any chart at any point in time to revisit the neckline from which it sprang, to just check it for footing. In the way I just named for 3 support zones. So there's going to be a battle at 104. The bulls will try. There's going to be a battle, actually, 102 and change. Battle on the 100 mark, and another battle around the 96 mark, and maybe they'll come back and fill this weird-looking gap right here. So that's my answer. And let me back into why. So now remember, I said catch the falling knife. It made sense. And now I'm saying throw away the rip. It doesn't make sense. And here's why. So before the pandemic, this was where the world was perfect before COVID. For Starbucks, all stores were open, cranking sales left and right. I could walk in, I could walk out, I could drive in, I could drive out. No restrictions. Company as profitable as it's ever been, and then the world ended for it. And it hasn't come back. They have not gone back to normal business operating procedures, at least not in California. I haven't been back to a Starbucks since then. Check that. I went to buy, no, did I? No, it was actually a Starbucks within a store, like Ralph's or something, a grocery store. So I bought coffee grounds. So they have not gone back to normal. That's why their fundamentals have been decimated. And don't take my word for it. Let's just go there right now, and then we'll go back to the logic. This is reality now for Starbucks. Let's go here. All right, this is the income statement side. Let's say the sales are flat. They're not, but let's say they are. They're slightly, let's call them flat, the blue lines. The green lines disappeared. That's the net income, and we'll talk about that in a little bit. The profit margins have plummeted, but they were already down 19 to 18. So 2020, I'll give them a pass on profitability. They needed to do whatever they needed to do to withstand the worst kind of conditions. Now here comes the problems. Assets and liabilities grew, but the liabilities are growing at a much faster rate. So the debt to assets ratio is ascending. And then you have cash flow from operations, that the blue one went from 12 billion to what's that number here? 2.8 billion. I wish that pop-up doesn't pop right in the middle. So right there is 2.8 versus 12. This is cash from their operations. Went to 2.8 from 12. That's a huge chunk of cash gone. So that's a problem. We'll go to the income statement. Sales, let's assume they're flat. They're flat-ish. The net income went from an average of 3.66 billion for the first 3 years. So 2017, 18, and 19. Average amount is 3.77. Now it's 665 million trailing 12 months. So this is a 12 months look back. That's a huge drop. So I'm not saying it's going out of business. But what I'm saying is, okay, you want to bring price back towards normal. I get it. Like the airlines, they went part, not all the way up to the crash site. I guess bad words for an airline industry, but where the accident scene happened, where the world ended for their business as we know it, and the airlines are still somewhere down here. Whereas this guy not only met and exceeded, went ahead to make new all-time highs. So the stock has never been, the company situation has never been worse, and the stock has never been higher. I don't get it. I would get it. It's the same conversation with Disney, by the way. However, I can believe it in Disney. You can convince me in Disney that, hey, you know what? It's a new business because now we have streaming. We have 150 million streamers. It's 150 million-ish because it's 100 million just from Disney, and then about 50 million from other companies they own like Hulu. And so they have that business growing faster, much faster than Netflix. So now we're chasing Netflix type of dollars into the Disney stock. I get that. I'll buy it. But not to buy the stock. I'll buy the concept. But here, I don't buy it. I would buy the stock for an investment on a dip. I could trade the stock on upside, but as a trade. Like, I get in for a reason, I get out for a reason. Like here, if I was watching the stock and it had a fail and it's coming into the third time, I would say chase it if it breaks out, because that's a breakout, and the upside, I can calculate the upside potential, and this one over-delivered, of course. The upside potential should have been here, and in fact, they stalled here. But they keep outdoing themselves, so it just doesn't make sense. The least I can say is, hey, you know what? Maybe I'm missing a piece of this puzzle. So if my brother comes to me and says, hey, what do you think of that stock? I would, again, repeat my answer. This is not an obvious point of entry. I'm lazy. I like obvious wins, or at least not obvious potential mistakes. And this is an obvious potential mistake. Not a mistake, potential mistake. So if I were to vote in or out for me, for my own money as an investment, like if this is a stock I want to hold for a long time, why get in at the highest possible moment at the worst possible moment? It just doesn't make sense. So this is my statement on this company, and this is not a call to short it, because I just told you why I wouldn't short it. It's like one of the strongest gazelle out there. Why don't you chase the one that's limping? Why chase the one that's running the fastest? And I have nothing to short it against. I have no reference points. So where do I stop myself out if I short it? That's kind of a thing. All right. Nick signing out.